What if I told you that the entire financial system that governs your life, your money, and your debt was designed in secret? That, 100 years ago, a handful of the world's most powerful bankers vanished to a remote island and returned with a plan that would become the Federal Reserve. This isn't some forgotten footnote in a dusty history book. This is the story of how the architecture of your financial world was built behind closed doors. They say the echoes of that secret meeting control more of your life than you could ever imagine. And the story doesn't begin on that remote island. It begins in the heart of a nationwide panic, a time when the American dream was teetering on the brink of collapse. Before we get to the secret, you have to understand the chaos that made it possible. The early 1900s in America was a time of wild contradictions. We had towering skyscrapers and roaring factories, incredible wealth, and a sense of boundless optimism. But just beneath that gilded surface, the nation's financial system was a house of cards. America was the only major industrial nation without a central bank, and that left it dangerously exposed. The system was just a volatile patchwork of thousands of individual banks, each looking out for itself. There was no lender of last resort, no one to step in when the fear took over the markets. The money supply was inelastic, a fancy way of saying that it couldn't grow or shrink when the economy needed it to. This created a brutal cycle of boom and bust. When times were good, credit was cheap and people gambled big. But the second that confidence faltered, a single bank failure could trigger a terrifying chain reaction. And that's exactly what happened in the fall of 1907. It all started with greed and a failed gamble. A copper tycoon named F. Augustus Heinze tried to corner the market on United Copper Company stock. He failed. The banks that funded his risky bet started bleeding money. One of them was the Knickerbocker Trust Company, New York City's third largest trust. Word of its troubles spread like wildfire. Panic hit the streets. Depositors, terrified of losing their life savings, lined up for blocks to demand their money. But banks don't keep all your cash in a vault. They lend most of it out. When everyone wants their money at once, the system simply breaks. They called it a bank run, and it was a death sentence. The fall of the Knickerbocker sent shockwaves across the country. One by one, other banks and trust companies buckled. The New York Stock Exchange plummeted, at one point falling nearly 50% from its peak the previous year. Credit froze solid. Businesses couldn't get loans for payroll. Farmers couldn't get credit for seed. The panic spread from Wall Street to Main Street, leaving bankruptcies and unemployment everywhere. Industrial production cratered by 11%, and unemployment skyrocketed. The US government was powerless. Without a central bank, it had no way to pump money into the starving system. In the end, the crisis was stopped, not by the government, but by one man, the titan of Wall Street, J.P. Morgan. He was, for all practical purposes, America's one-man central bank. Morgan summoned New York's top bankers to his library, locked the doors, and forced them to pledge their own fortunes to save the failing system. He organized a bailout, deciding who would live and who would die. He saved the day, but the whole mess exposed a terrifying truth. The financial state of the entire country rested in the hands of a few private, unelected bankers. The Panic of 1907 was a national trauma. It convinced just about everyone, from Wall Street financiers to populist politicians, that something had to change. The system was broken. America needed a more stable, elastic currency. It needed a financial firefighter. The question was, who would design it? And more importantly, who would control it? The public was deeply suspicious of Wall Street's money trust. Any plan that even looked like it was written by the big bankers was doomed from the start. A solution had to be found, but it had to be found in secret. The stage was now set for a clandestine trip to a very remote, very private island. In November 1910, 3 years after the panic, a private train car sat waiting in a quiet corner of a New Jersey station. One by one, under the cover of darkness, a group of men snuck aboard. Now, these weren't just any men. They were among the most powerful figures in America, and their wealth and influence were immense. To the train's staff, however, they were just a bunch of buddies on a duck hunting trip. They were told to only use first names to avoid being identified. They called themselves First Name Club, and their destination was Jekyll Island, Georgia. Jekyll Island was the perfect cover. It was a private, exclusive club, once called the richest, the most exclusive, the most inaccessible club in the world. Its members were the titans of industry and finance, Rockefellers, Vanderbilts, and J.P. Morgan himself, who helped arrange the clubhouse for this secret project. Here, totally cut off from the press and the public, they could design a new American financial system in complete privacy. So, who were these secret architects? First, you had Senator Nelson Aldrich of Rhode Island. He was the head of the National Monetary Commission, a government group created after the 1907 panic to study banking reform. He was also a powerful Republican insider and the father-in-law of John D. Rockefeller Jr., connecting him to one of the world's greatest fortunes. Aldrich was the political muscle. Then came the bankers. Henry P. Davison, a senior partner at J.P. Morgan & Co., was there representing the Morgan Empire. Frank A. Vanderlip, president of National City Bank of New York, was a giant with deep ties to the Rockefellers. He later admitted how crucial the secrecy was, writing, "If it were to be exposed publicly that our particular group had gotten together and written a banking bill, that bill would have no chance whatever of passage by Congress." And then there was Paul M. Warburg, a German-born partner at the investment bank Kern, Loeb & Co. Warburg had seen the stability of European central banks up close and had been pushing for one in America for years. His technical genius was the intellectual engine of the whole operation. Also in the group were A. Piatt Andrew, the Assistant Secretary of the Treasury, and Arthur Shelton, Aldrich's secretary. It's been claimed that these 6 men represented as much as a quarter of the world's wealth at the time. While that figure is likely an exaggeration, there's no doubt they were an incredibly powerful group. The cover story was a duck hunt, and they stuck to it. One of them even carried a borrowed shotgun for effect. But they didn't do any hunting. For 9 straight days, these men were holed up in the Jekyll Island clubhouse, working non-stop. They argued, debated, and drafted the blueprint for America's central bank. They genuinely wanted to prevent another devastating panic like the one in 1907. They wanted an elastic currency that could expand when farmers needed credit and shrink when they didn't. They needed a lender of last resort to stop bank runs in their tracks. But they were also driven by self-interest. They were bankers after all. They wanted a system that would be, at its heart, controlled by other bankers. They wanted to centralize power and protect their industry from both market volatility and the unpredictable will of the people. They were terrified of populism. Politicians like William Jennings Bryan had spent years railing against the power of Wall Street, so any plan that smelled of a banker takeover was dead on arrival. The secrecy was everything. For years, the men who were there flatly denied the meeting ever happened. It wasn't until the 1930s that the truth started to trickle out. B.C. Forbes, the founder of Forbes magazine, later called the trip the strangest, most secret expedition in the history of American finance. He said the story sounded so much like a conspiracy novel that many people refused to believe it. But it was real. And the plan they hatched on that island would, after a few years of clever rebranding, become the law of the land. For 9 days on Jekyll Island, the 6 men wrestled with 2 competing goals. First, create a central bank powerful enough to stabilize the entire US economy. Second, disguise it so well that the American public would never realize it was a mechanism for concentrating financial power in the hands of a few big banks. The blueprint they came up with was called the Aldrich Plan. On the surface, it seemed to respect the public's fear of a single powerful bank. Paul Warburg, who had a sharp read on American politics, knew that proposing one Bank of the United States was political suicide. So, the Aldrich Plan proposed a decentralized system, a National Reserve Association, with 15 regional branches spread across the country. This gave the illusion of local control, making it seem like bankers in Dallas or Richmond would be calling the shots in their own backyards, free from Wall Street's grip. But that was a carefully crafted illusion. The real power was buried in the details. While member banks elected the directors of the regional branches, the voting was weighted. The bigger the bank, the more votes it got. This ensured that the largest financial players would always dominate the regional boards, and those regional boards would, in turn, elect the directors of the national body in Washington. It was a brilliant piece of political engineering, a system that looked democratic and decentralized, but was built to be run from the top down by the very interests it was supposed to regulate. The proposed National Reserve Association would do exactly what a central bank does. It would hold the reserves of member banks, creating a central pool of money for crisis. It would issue currency, creating the elastic money supply everyone wanted. This new currency would be based not just on gold, but on commercial paper, basically short-term business loans, making it a liability of the bank, not the government. And crucially, it would be the lender of last resort, providing emergency loans to stop panics. Senator Aldrich had initially pushed for a system almost entirely controlled by bankers, but he eventually agreed that, to get the plan passed, the government would need some representation on the board. It was a small concession to create a veil of public oversight for what was, in essence, a private banking cartel. The plan was a direct answer to the chaos of 1907. The bankers on Jekyll Island would have argued they were performing a patriotic duty. And in some ways they were, but critics saw something very different. They saw a plan cooked up by the Money Trust to cement its own power. Congressman Charles Lindbergh Sr. didn't mince words. The Aldrich Plan is the Wall Street Plan. It means another panic if necessary to intimidate the people. They had designed a fortress to protect the banking system, but the fortress was designed by the men who would live inside it, and they would hold all the keys. They had a brilliant technical solution. Now they just had to sell it to a deeply skeptical nation. The Aldrich Plan, born in secret, was introduced to the public in 1911, and it was met with exactly the kind of suspicion its creators had feared. Despite the clever disguise, opponents immediately saw it for what it was: a plan for Wall Street, by Wall Street. With Democrats winning the House in 1910 and the presidency in 1912, the Aldrich Plan was politically toxic. It was officially defeated. But the ideas from Jekyll Island were far from dead. The problems of 1907 were still real, and the demand for reform was stronger than ever. The Democrats, now in power with President Woodrow Wilson, needed their own solution. What happened next was a masterclass in political rebranding. They took the core architecture of the defeated Aldrich Plan, gave it a new name, and put a new public-friendly face on it. The new bill was called the Federal Reserve Act. It was skillfully pushed by Democratic Congressman Carter Glass and Senator Robert Owen, who built directly on the foundation laid at Jekyll Island. They understood the key to getting it passed was to emphasize public control over private control. The final law, signed by President Wilson on December 23, 1913, was a brilliant compromise. It kept the essential structure of the Aldrich Plan, but added more layers of government oversight. Like the Aldrich Plan, the Federal Reserve Act created a system of regional reserve banks, 12 of them this time. This kept up the appearance of decentralization, but crucially, the Act also created a central governing body in Washington, D.C., the Federal Reserve Board. The members of this Board of Governors would be appointed by the President and confirmed by the Senate, giving it the stamp of public accountability the Aldrich Plan had lacked. This created the unique public-private hybrid we still have today. The Board of Governors in Washington is a government agency, but the 12 regional Federal Reserve banks are organized like private corporations. The private member banks in each district are required to buy stock in their regional Fed and even receive a dividend. So, is the Fed public or private? The answer is both, and that's by design. The core functions dreamed up on Jekyll Island remained. The new Federal Reserve System could issue a new elastic currency, the Federal Reserve Note, the very cash that's in your wallet today. It could act as a lender of last resort through the discount window, giving loans to member banks to keep the system stable, and it became the primary banker for the US government. In the end, the bankers got what they wanted. They got a central bank to backstop their industry and provide a permanent supply of cash. They lost the battle over explicit private control, but they won the war. The Federal Reserve Act put their secret plan into law. The structure designed on Jekyll Island was now a reality. Supporters hailed it as a great achievement that would finally tame the economy. But critics warned that a small group of powerful men had just installed a mechanism that gave them unprecedented influence over the nation's money. A system designed by bankers, they argued, would inevitably serve bankers. The real consequences, they warned, would be felt not in boardrooms, but in the wallets of ordinary Americans. Through the slow burn of inflation and the relentless growth of debt, they were about to be proven right. The Federal Reserve was sold as the key to a safer, more stable financial system. It was supposed to end the brutal boom and bust cycles that had plagued America. But over the last century, a very different story has played out. The institution born on Jekyll Island has become the engine of two of the most powerful forces in modern life: permanent inflation and unimaginable debt. Let's start with inflation. The men on Jekyll Island wanted an elastic currency, and boy did they get one. The Federal Reserve can expand the money supply, essentially creating money out of thin air. While a small amount of inflation is often an intentional policy goal to encourage spending, the long-term effect has been devastating to the value of your money. Since the Fed was created in 1913, the US dollar has lost over 96% of its purchasing power. What cost you $1 back then would cost you around $30 today. This isn't an accident. It's a direct result of a system that constantly prints more money. Think of it as a hidden tax. Every time the Fed creates new money, it devalues every dollar already out there. Your salary might go up, but if the cost of everything that you buy is rising just as fast, you're not really getting ahead. You're just running faster on a treadmill to stay in the same place. This slow, steady erosion of your savings is one of the biggest legacies of the system created in 1910. This leads us to the second consequence: debt. The Federal Reserve's most important customer is the US government. The Fed makes massive government debt possible. Here's how it works. When the government wants to spend more money than it has, it issues treasury bonds. The Federal Reserve then buys those bonds. To do this, it doesn't use tax money. It just creates the money with a digital keystroke. This process is called monetizing the debt. It allows the government to run up deficits on a scale that would otherwise be impossible. Without the Fed as a guaranteed buyer, the government would have to offer much higher interest rates to get people to lend it money. The Fed's money creation power allows politicians to fund programs without sending you a direct tax bill. The cost is simply paid through inflation and the ever-growing mountain of national debt passed on to future generations. Today, the Federal Reserve is one of the single largest holders of US government debt, owning trillions of dollars worth. And what about the boom-bust cycle? The very problem the Fed was supposed to fix. Critics argue the Fed hasn't eliminated the cycle, it has made it worse. By manipulating interest rates and holding them artificially low, the Fed encourages bad investments and fuels giant speculative bubbles. When credit is too cheap, businesses and consumers take on way too much debt. Money pours into risky ventures, whether it was dot-com stocks in the 90s or subprime mortgages in the 2000s. An artificial boom is created, but it's unsustainable. Eventually, the Fed has to raise rates to fight the inflation its own policies cause. The cheap money spigot gets turned off, and the bubble bursts. From the Great Depression, which economists like Milton Friedman argued was made far worse by the Fed's mistakes, to the financial crisis of 2008, the Fed's fingerprints are all over the major economic disasters of the last century. Instead of providing stability, the system has institutionalized a cycle of boom and busts, each one bigger than the last. The story of Jekyll Island isn't just history, it's the origin story of the world we're living in right now. The same pattern of crisis, secrecy, and top-down elite decisions is far more powerful today than ever. The core idea from 1910 that a small unelected group of financial experts should manage the economy has become the unquestioned reality of our time. You don't have to look any further than the 2008 financial crisis. Just as the panic of 1907 led to the secret meeting on Jekyll Island, the 2008 collapse led to a massive expansion of the Fed's power. The crisis began in the housing market, a bubble that many argue was fueled by years of the Fed's own low-interest rate policies. When it burst, it threatened to take down the entire global financial system. And what did the Fed do? It acted as the ultimate lender of last resort, just as its creators intended, but on a scale they could have never imagined. The Fed, along with the Treasury, organized huge bailouts for the largest banks, the same too-big-to-fail institutions whose reckless behavior helped cause the crisis. This created a firestorm of criticism, as it looked like Wall Street was being rescued, while ordinary people lost their homes and jobs. But it didn't stop there. The Fed unleashed a radical new policy, quantitative easing, or QE. This is just a modern, supersized version of monetizing the debt. The Fed started creating trillions of dollars to buy not just government bonds, but also toxic mortgage-backed securities from the banks, flooding the financial system with new money. And just like in 1910, these enormous decisions were made by a handful of people, far from any public debate. The echoes are impossible to ignore. A crisis born from a speculative bubble leads to a top-down solution engineered by financial elites. The solution always seems to involve creating huge sums of new money and giving more power to the central bank. And the result is a system that protects the biggest players, while the public deals with the consequences. Today, the Federal Reserve is more powerful than at any point in its history. Its balance sheet has exploded from less than $1 trillion before 2008 to many times that size. Every single word from the Fed chairman can send global markets soaring and crashing. The core fear of the original critics has been fully realized. We've concentrated far too much power in the hands of a few. We are all living in the world they built. A world where the solution to every crisis is more debt and more money printing. The secret of Jekyll Island is that its consequences are all around us. If you want to uncover more of the hidden history that shapes your world, subscribe to the channel and hit the notification bell. These stories aren't just in the past, they explain the present. What other historical secrets should we investigate? Let us know down in the comments below. It all started with a secret trip to a private island, a duck hunt that was anything but. 6 powerful men gathered to solve a national crisis, and they came back with a blueprint for a central bank they believed would save America. But the institution they created, the Federal Reserve, did more than that. It fundamentally changed the relationship between the government, the banks, and the American people. The story of Jekyll Island is the story of how power really works. It shows how huge, system-altering decisions can be made by a small, insulated group far away from public opinion. It reveals how a solution designed by an elite group will, almost inevitably, protect the interests of that group. The Federal Reserve Act of 1913 was sold as a win for public oversight and financial stability, and in some ways it did prevent the frequent chaotic bank runs of the past, but it came at a staggering cost. It created a machine for generating inflation and enabling debt. A machine that has been running for over a century, slowly devaluing the savings of ordinary people and allowing government spending on a scale that was once unthinkable. It replaced the sharp, painful panic of the old days with a chronic, systemic instability where the booms are artificial and the busts are paid for by everyone. The debt that burdens our country, the dollars that buy less every year, the feeling that the economic game is somehow rigged. The roots of it all can be traced back to 9 days in a secluded clubhouse off the coast of Georgia. The men on Jekyll Island wanted to build a fortress to protect American finance. They succeeded. But the rest of us are living outside its walls, paying to maintain a structure we never had a say in building. The real secret of Jekyll Island is that your financial life was designed, and it was designed without you in mind. I've been Josh. Thank you for watching. This is The Villainous Vault.